Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it.
Welcome, and thank you for joining this crash course on strategic finance. Today, we'll explore key concepts and tools that help organizations manage their finances with a clear, forward-looking approach. The goal is to understand how financial decisions support broader business strategies, making sure every choice contributes to long-term success. Let's dive in and start building a strong foundation in strategic finance together. Strategic finance is about using financial insight to guide key decisions that impact the whole business, from markets and products to pricing and capital allocation, instead of just looking backward at what happened. It combines traditional financial planning and analysis with corporate strategy and capital markets thinking, creating a unified approach that helps leaders act faster and more confidently with a clear understanding of trade-offs. Simply put, it turns numbers into a story and then turns that story into action. It goes beyond just budgeting by asking important questions like which products or segments really add value, what our path to profitable growth looks like, how to invest resources for the highest return, and how to manage risks. When done well, it brings clarity about what truly affects business success, builds confidence to push forward or pause initiatives based on solid evidence, and earns credibility with stakeholders because the financial story connects directly to value creation, not just surface level metrics. This approach changes finance from a passive recorder of facts into an active advisor shaping strategy and outcomes. By focusing resources on activities that deliver the highest returns, businesses can shift budget and talent away from less productive areas to those that drive growth, using detailed analysis of profit pools segmented by customer, channel, or product. Pricing and product decisions become more effective when grounded in contribution margin and price elasticity, allowing companies to set prices that reflect value, manage discounting strategically, and eliminate features that hurt profitability. Decision-making speeds up and becomes much clearer with dashboards and memos that consolidate key data, cutting down what might be weeks of discussion into a single meeting. Cash and capital planning is strengthened by translating strategic goals into concrete, short-term cash forecasts and capital structure plans, allowing businesses to better prepare for various liquidity scenarios using a 13-week cash view and different financing options. Finally, aligning operational metrics like revenue quality, gross margin trends, customer acquisition payback, and return on invested capital to shareholder value helps businesses craft stories that resonate with investors and boards, making it easier to secure capital on favorable terms. Start by creating a simple equation that explains how your business generates value. This usually involves breaking down revenue growth into the number of customers multiplied by average revenue per user, adjusted for churn. Then subtract costs of goods sold to get gross profit, and from that, subtract operating expenses by function to find operating profit. Next, calculate free cash flow by adding back non-cash items and subtracting capital expenditures and changes in working capital. The value of the business can then be estimated using free cash flow divided by the cost of capital minus growth for a steady state, or by a multi-year discounted cash flow model. The goal here is to produce a one-page driver tree showing the 5 to 7 most important metrics that drive value. Once that's clear, build a clean financial model with 3 statements: income, balance sheet, and cash flow, driven by operational inputs like pricing, volume, churn, and productivity. Keep your assumptions separate from your outputs and set up scenarios for base, upside, and downside cases. Define unit economics specific to your business segment, such as customer acquisition cost and lifetime value for SaaS, or average order value and contribution margins for e-commerce. Your deliverable is a rolling 24-month monthly model with scenario toggles and a 13-week cash view. Finally, connect this to capital allocation by establishing a clear rubric with hurdle rates and stop-loss rules, so you know when to cut losses if certain milestones aren't met on time, preventing wasted spending and focusing resources where they generate the most value. Start by identifying a single North Star metric that clearly links to your company's long-term value, such as contribution profit per active customer. Around this, set guardrails like gross margin percentage, burn multiple, net retention, and cash runway months to keep a balanced view of performance and risks. Establish an operating cadence where weekly metrics focus on leading indicators like pipeline coverage and win rates, monthly reviews cover P&L close and cohort economics, and quarterly meetings refresh strategy and check capital allocation. Create a one-page KPI scorecard with clear thresholds, green, yellow, and red, assign owners, and note next actions to maintain accountability and clarity. Moving forward, run real scenario planning by modeling various what-ifs such as pricing changes or supply disruptions, stress testing working capital components like day sales outstanding and inventory aging, and pre-writing decision triggers to respond quickly if cash runway shrinks. For major decisions like pricing shifts or expansions, prepare concise two-page decision memos outlining the problem, options, financial impacts, risks, recommendations, success metrics, and a 90-day action plan with owners. Finally, build trust by aiming for a close process that completes accurately within 5 days of month end, uses bridge charts to explain variances clearly, and standardizes charts of accounts and naming conventions, automating where possible to ensure consistency and reliability. A mid-market SaaS company faced flat revenue despite growing its user base. By segmenting customers based on their willingness to pay and how intensely they use the product, they redesigned their pricing from a per-user model to a value-based model, charging per unit like API calls and introducing package tiers. This increased their average revenue per user and gross margin, while churn stayed low due to grandfathered contracts and clear communication of value. In another case, an e-commerce brand was growing top-line revenue but losing money because of returns, freight costs, and excessive discounting. Strategic Finance rebuilt the profit and loss by SKU and channel, identifying loss-making products and influencers. They then cut unprofitable SKUs, renegotiated logistics contracts, introduced packaging that reduced returns, and shifted marketing spend towards higher return search ads, which increased contribution margin and turned the business break even in 2 quarters. A manufacturing plant increased shifts to meet demand, but profits lagged. Using constraint analysis, they pinpointed the CNC machine as the main bottleneck, so they rebalanced the line, focused on high-margin products through the constrained resource, and outsourced low-margin custom work. This improved contribution per constraint hour, cleared backlogs without capital investment, and raised operating margins. Lastly, a B2B service provider with unpredictable enterprise deals introduced a 13-week cash flow model, adjusted credit facilities with springing covenants, and harmonized vendor terms. These moves extended their financial runway by months without needing more equity and helped avoid covenant breaches during slow periods. All these examples show how targeted financial strategies can solve specific business challenges by aligning pricing, operations, and capital with strategic goals. To help apply strategic finance in your business, there are several practical tools and templates you can start using right away. First, the unit economics checklist breaks down key financial factors like customer segments, pricing after discounts, variable costs, and contribution margins at both unit and order levels. It also covers customer acquisition costs by channel, payback periods, lifetime value incorporating retention and expansion, and sensitivity analyses to test how changes in price, volume, or CAC impact profitability. Next, the 13-week cash view provides a rolling forecast of opening cash, collections segmented by customer aging, and disbursements including payroll, rent, COGS, taxes, and debt. It tracks net cash changes and minimum cash covenant requirements, and includes trigger rules to act if runway falls below 12 months, such as implementing hiring freezes, renegotiating vendor terms, or testing pricing adjustments. The decision memo template organizes your choices clearly, outlining context and objectives, multiple options including doing nothing, financial impacts across scenarios, risks and mitigation plans, and a recommended decision with key performance indicators. It also guides planning a 30, 60, and 90-day rollout with senior leadership. Finally, the KPI scorecard enables monthly tracking of crucial performance metrics across growth, profitability, cash runway, efficiency ratios like CAC payback and LTV, CAC, and quality measures including customer satisfaction and churn rates. Using these tools consistently can drive better decision-making and resource allocation aligned with your strategic finance goals. Focusing on a few key value drivers helps teams stay aligned and concentrate on what really matters, which creates clear priorities and faster decisions since predefined criteria cut down on unnecessary debate. It also makes better use of resources like cash, inventory, and personnel, improving capital efficiency. Plus, having scenarios and triggers ready helps teams react early to risks without panic, keeping the organization prepared. When numbers support the story, it builds credibility with stakeholders and guides effective execution. On the downside, spending too much time on detailed modeling can lead to analysis paralysis, where the model becomes the focus rather than the outcomes. Poor data quality will also produce misleading insights, and incentives tied to vanity metrics can prevent real behavior change. Transparency might initially feel uncomfortable and require deliberate change management, and forecasts should always include confidence ranges to avoid false precision. To manage these risks, keep your KPIs limited to around 5 to 7, use a single data taxonomy for consistency, clearly publish decision rules, and review assumptions regularly, ideally every month. This balance helps maintain both clarity and rigor in strategic finance. In the first 30 days, focus on mapping out the value driver tree and agreeing on 5 to 7 key performance indicators that will guide your decisions. At the same time, build a driver-based model that includes base, upside, and downside scenarios to help with forecasting. Establish a 13-week cash flow forecast, making sure to fix the chart of accounts and close the calendar properly for accuracy. Moving into days 31 to 60, start running pricing and mix analyses and consider proposing tiering or discount policy changes based on your findings. Build detailed unit economics by segment and channel, highlighting any negative contributors that need attention. Draft a capital allocation rubric to prioritize investments along with stop-loss rules to limit downside risk. From days 61 to 90, move to execution by implementing 1 or 2 high-impact changes, such as adjusting pricing, pruning SKUs if relevant, or renegotiating vendor terms. Publish a first board quality pack that clearly links KPIs to value creation and cash performance. Finally, institutionalize disciplined decision-making by adopting decision memos and monthly variance bridges. This 90-day plan sets a clear cadence and foundation to drive strategic finance efforts effectively. Strategic finance is about making smarter choices, not just handling bigger spreadsheets. When you identify your key value drivers, create a clean, flexible model ready for different scenarios, and set clear rules for capital allocation, you turn financial data into a real advantage for your business. This approach improves your profit and loss outcomes by increasing margins, streamlines your balance sheet through more efficient working capital, and most importantly, boosts your confidence in making decisions. A good way to start is with a simple driver tree to map out what matters most, a 13-week cash flow forecast to stay on top of liquidity, and a concise decision memo to recommend actions. From there, you can expand these practices across your business, leading to clearer insights and better financial performance.
Hello. If this video was useful, you'll find some more useful business and finance topics on the channel. And thank you very much for watching.